What if you took $100,000 and put it into US real estate? What kind of return would you actually see? Forget the hype and the get-rich-quick stories. Today, we're doing a deep dive into the real numbers. We'll break down exactly what happens to your money from the moment you invest until you see those returns hitting your bank account. We're going to cover everything rental income property appreciation, the taxes you can't avoid, those surprise maintenance costs, and most importantly, your actual cash flow. So, let's set the stage. You've got $100,000 ready to invest. In today's US market, this is most likely going to be a down payment on a property, not the full purchase price. Now you have a $320,000 mortgage. Let's assume a 30-year fixed-rate mortgage at a 7% interest rate. Your monthly mortgage payment, which includes principal and interest, would be around $2,130. But wait, that's not your total monthly housing cost. We also have to factor in property taxes and homeowners insurance. This is often called PITI, principal, interest, taxes, and insurance. Property taxes vary wildly across the U.S., from as low as 0.3% in some states to over 2% in others. Let's use a national average of about 1.1% on a $400,000 home. That's $4,400 a year, or about $367 per month. Homeowners insurance also varies, but a reasonable estimate is around $150 per month. So, your total PITI payment is roughly $2,130 plus $367 plus $150, which comes out to $2,647 per month. This is the baseline costs you need to cover before you make a single dollar. Now for the fun part. Rental income. To make this a good investment, the rent you collect must be higher than your monthly PITI. The amount you can charge depends heavily on the location, the property's condition, and local demand. Let's say for our $400,000 property, you can realistically charge $3,000 a month in rent. On the surface, this looks great. You're collecting $3,000 and your PITI is $2,647, leaving you with a positive cash flow of $353 per month. Right? Not so fast. Not so. This is where many new investors make a critical mistake. They forget about the other expenses. First, vacancy. Your property won't be occupied 100% of the time. A conservative estimate for vacancy is 5% of the annual rent. So, 5% of $36,000 a year is $1,800 or $150 per month that you should set aside. Next up, repairs and maintenance. The roof will leak, the water heater will break, and appliances will need replacing. A common rule of thumb is to budget 1% of the property's value annually for maintenance. For our $400,000 home, that's $4,000 a year, or about $333 per month. Some months you'll spend nothing, but other months a single repair could cost thousands. So you need this fund. Then there's property management. Are you going to manage the property yourself or hire a professional? If you self-manage, you save money but spend your time dealing with tenants, calls, and repairs. If you hire a property manager, they typically charge 8 to 10% of the monthly rent. Let's use 10% for our calculation. That's $300 per month off your rental income. So, let's recalculate our monthly cash flow. We start with $3,000 in rent. Wait, what? A negative cash flow. Is this a terrible investment? Hold on, this is just one piece of the puzzle. This negative cash flow is an important reality check. Many properties, especially when you're first starting out with high leverage, don't produce immediate positive cash flow. But cash flow isn't the only way you make money in real estate. Let's talk about the other components of your return. The first one is debt paydown. Every month, a portion of your $2,130 mortgage payment goes towards the principal of your loan. In the first year, this is about $450 per month. This is forced savings. You are building equity in the property simply by paying your mortgage, which your tenant is mostly covering. Over a year, that's $5,400 in equity you've built. The second, and often most powerful, component is appreciation. This is the increase in the property's value over time. Historically, U.S. real estate has appreciated at an average rate of about 3 to 5% per year. Let's be conservative and use 3%. A 3% increase on a $400,000 property is $12,000 in the first year alone. This isn't cash in your pocket, but it is a massive boost to your net worth. So, let's put it all together to see our true return on investment for the first year. Your initial cash investment was $100,000. Your cash flow for the year was negative $430 per month, totaling a loss of $5,160. But you built $5,400 in equity from paying down the mortgage, and the property appreciated by $12,000. So, your total gain in net worth is the appreciation plus the equity paydown, which is $17,400. From this, we subtract our cash flow loss of $5,160. That leaves a total net gain of $12,240 in the first year. To calculate your return on investment, or ROI, you take that net gain and divide it by your initial cash investment. So, $12,240 divided by $100,000 gives you a return of 12.24% in the first year. That's a very solid return, much higher than you might get from safer investments. And we were using pretty conservative numbers. And we haven't even talked about the tax benefits. As a real estate investor, you can deduct many of your expenses, including mortgage interest, property taxes, insurance, and repair costs. But the biggest tax advantage is depreciation. The IRS allows you to deduct a portion of your property's value over 27.5 years, assuming it's wearing out. This depreciation can offset your rental income, often making it tax-free. In our example, since we already have a negative cash flow, this large paper loss can potentially be used to offset other income you have, saving you thousands in taxes depending on your financial situation. This is a huge benefit that accelerates wealth building. Now, you might be thinking, what if appreciation is zero? Or what if maintenance costs are higher? Those are valid risks. Real estate is not a guaranteed win. If you buy in a declining area, your property could lose value. If you have a string of bad luck with major repairs, your cash flow loss could be much larger. That's why your initial $100,000 included an emergency fund. You need a buffer to weather these storms. The power of real estate investing, however, lies in the long term. As Gierskovy, a few amazing things happen. First, your rents will increase with inflation. If your rent goes up by just 3% a year, in 5 years, you'd be collecting over $3,470 per month. Meanwhile, your main housing cost, the mortgage principal and interest, is fixed. It never changes. As rents rise and your mortgage stays the same, your cash flow will grow, eventually turning positive and becoming a steady source of passive income. Second, your loan balance shrinks every month, while your property value, on average, continues to climb. The gap between what you owe and what the property is worth, your equity grows wider and wider. After days or 15 years, you might have hundreds of thousands of dollars in equity. You can then tap into this equity through a cash-out refinance or a home equity line of credit to buy another property and another and another. This is how real estate portfolios are built. So, is investing $100,000 in U.S. real estate today still a profitable move? Based on our detailed analysis, the answer is a resounding yes, if you do it correctly. It's not about getting rich overnight. It's about understanding the numbers, planning for expenses, and leveraging the long-term benefits of debt paydown, appreciation, and tax advantages. It requires patience, careful research, and a solid financial buffer. The key takeaway is that your true return is a combination of these 4 pillars: cash flow, appreciation, loan, paydown, and tax benefits. Don't just focus on monthly cash flow, especially in the beginning. Look at the bigger picture and how you are building long-term wealth. With the right strategy, that initial $100,000 investment can be the foundation of your financial freedom. If you found this breakdown helpful, make sure to like this video and subscribe to the channel for more detailed financial analysis. Let me know in the comments what you think the most important factor for a successful real estate investment is.